When there's a lot of background noise and the macroeconomic headlines are discouraging, it is difficult to make the most sensible investment decisions. Even so, many investors often make their best buying decisions precisely during the down market. One way to do it is to look at the company's earnings potential in the long term and identify prospective purchases and candidates. At Sifter, we use the earnings yield formula as one of the methods of equity evaluation, which evaluates the likely development of companies' profits 5 years from now. In the earnings yield, the return on investment is calculated by evaluating the business earnings for the 5 years and divided by the current stock price. As a result, we get a percentage that could be compared to, for example, the rental yield of the real estate or the bond yield. During the year, Sifter Fund's earnings yield percentage has risen significantly due to decline in the share prices. In other words, the company's future cash flows are now cheaper than before. However, there is another more important part of the formula than the share price: the company expected earnings. This raises a vital question. Can company earnings forecast be fully trusted in the current economic environment? Most of the company results have been better than expected this year. For example, most of the Sifter Fund companies had excellent Q2 results. After summer, however, there has been a growing fear in the markets about whether company profit expectations are too high. We think companies will perform differently and the result will vary in the coming months and years. For example, with the rise in interest rates, companies with a heavy debt loads must pay a high price for money borrowed, which of course will eat their profits. Inflation also affects the earnings of the companies in different ways. Due to high inflation, consumer purchasing power decreases and the company costs rise. Therefore, businesses with strong pricing power and clear competitive advantages play a crucial role in this market. The Sifter Fund's investment strategy has always been to invest in high-quality companies that should have the ability to withstand an economic downturn. Over the years, we have selected very healthy and debt-free companies whose earnings are predictable because their product and services are essential for their customers. This gives us and our investors peace of mind even in the current economic climate. For example, let's look at one of our investments, Novo Nordisk. Novo is a Danish pharmaceutical company that is a global market leader in diabetes medicines. We have calculated the 9% yearly earnings growth for the Novo over the next 5 years. Sifter earnings forecast is more conservative than the market consensus, which expects over 13% yearly growth. One of the things that makes Novo's business predictable is that the drugs manufactured by the company are critical for customers, and we very much doubt that their use will decrease even in recession. Let's take another example of a highly predictable company that even benefit from higher interest rates. Sifter portfolio includes automatic data processing or ADP, which offers payroll management software for companies. Every 5th private employee's salary in the US goes through the ADP software. At the same time, ADP temporarily receives billions of dollars, which it can invest in the bond market for a short time. According to our analysis, when interest rates rise by 1%, ADP's operating profit increases by an additional 8%. However, this was not the original reason we invested in the company, but it has turned out to be quite a positive thing in the market of rising interest rates. Other highly predictable companies in the Sifter Fund include Costco, West Pharmaceutical, VeriSign, Johnson & Johnson, ADP and even Microsoft. These companies have in common the fact that even if their customers' purchasing power decreases, we believe that the demand for their very critical services and products will not be reduced. Secondly, the margins of the high-quality companies are often very high and thus earnings are better protected than low-margin companies. The other key factors in Sifter analysis predicting future earnings are the demand for company products or services and their pricing power. Those factors affect on margins and earnings. We think that the pricing power of companies offering critical services is quite different from, for example, consumer good companies, which must compete for their consumers' everyday choices and shrinking purchasing power in recession times. In addition, according to our assessments, B2B companies can better transfer any increased cost to their price than B2C companies. About 80% of the Sifter portfolio companies operate in B2B business and few operate in both, such as Japanese Sony Corporation. Also, companies that provide services probably have an advantage over companies that manufacture and sell products. Some of the product manufacturing companies are suffering from a shortage of raw materials and increased raw material cost. Those makes earnings expectations unpredictable. An example of service company is VeriSign, the world's leading provider of domain names called .com and .net. It doesn't have to worry about raw material cost because the service is fully digital and scalable. The increase in wage cost is also relatively marginal concerning the company's turnover and profits. We believe that a similar logic works for several critical service providers in the ICT industry who have continuous service contracts in place. About half of the companies in Sifter portfolio can be classified as poor service companies. But yes, then we have companies which earnings are a bit more uncertain and more difficult to predict in. In that category goes the businesses which are more affected by decreasing consumer purchasing power and industry cyclicality. For this kind of investments, we always calculate more conservative estimates of future earnings than the market consensus estimates. One example in Sifter portfolio is the Autoliv, the global leader of passive safety equipment for cars. The demand for Autoliv products ultimately depends on consumer purchasing power. Therefore, we must have conservative earnings estimates for this company in this market. However, despite our conservative expectations, Autoliv's earnings yield at the current share price is one of the highest in the Sifter portfolio. Another aspect that we examine closely is the cyclicality of the industry and its effects on future earnings. Let's take an example from the semiconductor industry, which we know to be cyclical. At the peak of the economic cycle, customers buy microchips and devices for the storage. During a downturn, the demand for devices such as electronics, electric cars or data centers can wane, affecting the entire semiconductor value chain and its thousands of companies. So the question is, should we try to sell the stocks before cycle turns down and repurchase them later? That would be the market timing and very risky. The other option is to own them through the cycle and perhaps increase their position when stock prices have gone down. In our mind, cyclicality is not risk if one has considered it by adjusting own earnings estimates for long term. Sifter has selected 4 of the highest quality companies from more than 800 listed semiconductor companies. For example, Taiwan Semiconductor is the world's largest independent chip foundry. The company's earnings have increased by 12% annually over the past 5 years. The company management gave a target of 15 to 20% annual revenue growth for the next several years ahead. However, we have taken a slightly more cautious approach of 15% annual revenue growth and only 11% annual earnings growth for the next 5 years. If we look at the TSMC's stock price development in this year, we can see the stock market has already possibly anticipated the cycle's turn for semi companies. So, should one sell because of stock price has come down? When we look at the matter again in the long term, we get a slightly different picture of the TSMC's investment opportunity. When calculating at 11% annual earnings growth, we get almost 10% earnings yield for the 5th year. Considering this information, we want to be owner of this company and perhaps increase our position at the current share price. So what is the benefit of 5-year earnings yield and how does it help you to make better decisions? First of all, a 5-year clearly allows us to look beyond the short term. Even though the quarters or years are different, we can quite calmly monitor the business result of our investment without worrying too much about short-term fluctuation in stock prices. Secondly, the earnings yield enables companies and their shares to be comparable with each other, which helps to reduce risk and identify good places to buy more shares of quality companies. So, where's the opportunity for long-term investor in down market? Typically, when uncertainty about company future earnings increases, the market sentiment turns sour and the prices of all stocks drop too much. In moments like these, an investor should take his eyes off the stock market prices and next quarter results. Instead, one should evaluate earnings models, pricing power, and competitive advantages of potential investments in the long term. One should calculate long-term earnings returns using different scenarios and ask whether he wants to own these companies 5 years from now. And finally, I want to remind you that the companies presented in these presentations are not investment advice. The goal of the presentation is to share with our investors where we have invested and how we evaluate and monitor our companies when the stock market falls. We believe in long-term quality investing. It doesn't include steering stock prices in the short term and making decisions based solely on them. The global economy is affected by so many factors that sometimes it's impossible to model all scenarios in advance. Our company estimates might be incorrect, and this is why we use margin of safety in all our calculations to protect our investment hypotheses. One lesson learned from our experience is that if you don't know what to do, take a breath and consider doing nothing. This is often the hardest lesson of all to learn. Thank you very much and stay in touch.